Finally, the moment we've all been waiting for is here. The pullback to the bearish engulfer high in the daily 20 SMA has arrived. And per usual, there are some considerations that are complicating the issue, including what's happening with the ruling on tariffs and what Jensen just said about China winning the AI race. I'm here to simplify the major decision-making factors and help us figure out if this pullback should be bought or avoided like the plague. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight with a closer look at the SPY daily timescale to evaluate what exactly is going on here from a trend perspective. This, of course, is the all-time high, which means that it's the highest high in the trend count, and that's where the pullback has originated from. And that means that there's certainly an opportunity to set a daily higher low coming from the highest high in the trend count, and the daily trend would remain in the upward direction. So the next key question to ask and answer is, okay, where's the ideal location for that higher low to preserve the trend? Well, in a picture-perfect world, we would use previous resistance as newfound support. That's a bullish technical analysis 101 flip from resistance to newfound support. The icing on the cake is that we have the daily 20 SMA mixed in there. It's a gap fill reversal, and it is near the lower edge of the weekly expected move from an options pricing perspective. So location-wise, we have not overshot that level. It's actually a very clean hold so far of this ideal location. What's not so clean, though, is the actual structure intraday. You'll notice that on Tuesday, the market gapped down, and then it went for a full gap fill reversal and then closed underneath the opening print. That large upper wick to me indicates the continuation of responsive trade from sellers basically underneath previous 3-day balance range lows, as opposed to new money initiative buyers blowing right through that level and fighting for price acceptance inside of this 3-day balance range. And then lo and behold, you can see the same exact upper wick indication from today's Wednesday session as well. So location checks out as being correct, but the structure isn't quite convincing yet. Now, a caveat could simply be that we have not actually tested in the regular trading hours the 20 SMA. We have not technically closed the gap all the way to the Thursday high of what was now 2 weeks ago. So let's take it on down to the hourly chart. Let's get a little bit more nuanced and start talking about the trend here. On the hourly chart, the trend is definitively down. We clearly have these sets of lower highs coming in, which technically means that the hourly trend is down. Previous lows, lower lows, and then lower lows. So we are also getting lower lows, confirming the hourly downtrend. Now, this is actually a helpful indication because, as we know, the daily chart can only form a firm higher low, not a soft higher low, but a firm higher low when the hourly trend flips to down. So this is actually helpful. It's also going to make our job a little bit easier in terms of finding when the hourly trend flips back to up rather than banking on a breakout. So just on the same topic of discerning between a firm higher low and a soft higher low, if the hourly trend never flipped to down, we just had balance up here, let's say we went sideways, then we have to sort of trust a breakout up and over into blue sky territories. That's usually a little bit harder to do. You have to sort of trust the market there to explore and auction new prices versus trying to watch the auction flip and look for new money buyers on the low where there's a clean point to manage your risk against. So having this conversation, the main thing we're watching for, right? Location is correct. The hourly trend just needs to flip back to up in any configuration. So how might the hourly trend flip to up, and does it seem reasonable? Well, the easiest way to do it would be to bring in a higher high over this zone. You would need to rally tomorrow morning, set a higher low over 680.50, turn previous structural lows into newfound lows again, now that we're using them as resistance. Remember, this is the responsive rejection from Tuesday and Wednesday. You need to flip that script, and now all of a sudden we have an hourly uptrend, right? We have lows, higher lows, as well as previous highs, generally at these 2 arrows, and some kind of higher high would be coming in. That's an hourly reversal back to the upside. This will appear as a firm daily higher low. In hindsight, and beautiful, we look to move in the upward direction. So the asymmetric risk-reward bet is to trade for something initially like this, and then ballooning runners into the all-time high. That's how I'd look for this to unfold if the hourly trend is going to reverse, be it via, there we go, tongue twister, a breakout up and over this 680.50, okay? Now, you can clearly see that into the end of the day today, we didn't close high and tight consolidation. As a matter of fact, you actually looked over slightly. You looked over Tuesday's high and then failed back down into range. So what seems a little bit more reasonable could be, well, we know the market's been responsive over this week. If we rally and reject underneath 679.75, which is the more appropriate level from back here, we have a very nuanced lower high inside of what could now be considered a multi-day range, and we're probably just targeting the low end. And then what do we look for? Well, you don't want to be short here. You want to be short for risk and then reward as a range rotation. Maybe you can balloon runners to close the gap, but that's the secret right there, right? When and if we close the gap, when and if in the regular trading hours session we test that daily 20 SMA, that is where you want to button up the shorts and instead say, okay, if the pathing looks like this, can we get a full gap close? And when and if there's an hourly high or low back in this range here at 674.50 as of right now, that's the 2-day equal low from Tuesday as well as today's Wednesday low. If we can get that, now you're talking hourly low, higher low, trade to the equal high. You could look for the long here, risk, reward. And then because we've supported the gap fill, because we've supported the daily 20 SMA, lower edge of the weekly expected move, it wouldn't be unreasonable. Yeah, you could pull back from this, but the next step for the market would be to look for that higher high to come in up and over that 680.50. And now all of a sudden you have an earlier entry here and a more confident entry here on the long side. So because the market has not violated this clear area of support over the prior highs, my base case is to be neutral in this range. If we're responsive and go lower high here, that's fine. I'm not overstaying my welcome on the bear side. I'm looking for the initiative buyers to attempt to step up. Again, we have to see it to believe it, but the base case is to look for it first at the daily 20 SMA and the 672.65 gap fill reversal. Very nuanced take here that I want to share before we bring out the fibs and the anchored VWAPs. Notice that the original size of the gap was here. On the Tuesday gap down, sellers, if they were going to run away with this momentum to the downside, in the lower wick, all they needed to do was keep price under the opening print, close the gap all the way, and start to battle for acceptance lower into the close. That clearly didn't happen. You closed the gap all the way, sellers then stepped up, right? And then we close weak. And then here's where it gets even better. Wednesday's low of day wicks Tuesday's low of day, meaning that we moved back into the location where there is zero structure. If we had stronger sellers, they should have had no problem underneath Tuesday's low of day, today, Wednesday morning, to come in, test the daily 20 SMA, which was also the after hours low. If I throw on the extended hours chart, you can see we overshot this here, right? Here's the overshoot on the Asia market sort of blow up on AMD earnings thanks to SoftBank. And then here it is as a higher low coming into the morning. The fact that sellers could not get that job done is a subtle, not an overwhelming, but a subtle bullish data point, which is keeping me neutral in here and somewhat open-minded to either this in the upward direction or this in the upward direction with continuation possibilities aligning with that higher low over 680.50. Let's come in here with some interesting anchored VWAPs and Fibonacci's from the all-time high to the most recent low. What do we see? Fib 38.2 right at the sweet spot, reinforcing that we will invalidate bear flag consolidation should we get the higher low above that zone, should we bring in an hourly trend reversal. If we take the fib from this low, and we did this on the Saturday update video, but I'll reinforce it one more time, the fib 61.8, obviously it hasn't moved, it's right at this sweet spot for support still, close to the gap fill reversal, daily 20 SMA 672.65. Now, we've clearly talked about the bullish thesis and how this higher low can emerge, but what if this market is going to fail? What if we do not find buyers at this gap fill reversal? What if on the Thursday morning open, we get a hot knife through butter look and we get here? Well, that is bearish, right? That is inherently bearish, and therefore, once again, I'll say it, we need to see it to believe it at the 20 SMA gap fill reversal, or we need to see it to believe it over 680.50. If we start to see this, large red-bodied bars in here, consolidation underneath the gap fill reversal, underneath the daily 20 SMA, I would give the market the benefit of the doubt for some overshoot here. We'll talk about why with the NQ and the NASDAQ side in just a moment, but then it's game over. If we're underneath 669.65, you're probably talking about shorts available into the top end of the junk drawer from the bearish engulfer back here, which would be confluence at this point with the daily 50 SMA. Now, why is this such a threat and why is this an issue? Because if we move back to the daily time scale, and let's not speculate before we have to, right? We talked about this, I think quite literally the Wednesday video prior to the large red-bodied bear engulfer. I was saying, we could talk all day long about the head and shoulders, but until it happens, right, it's the same thing. We can talk all day long about this hypothetical breakdown, this hypothetical monster bearish reversal in the market, and this very well could be something that unfolds, but we need to at least see the first steps of this, which is a violation of this spot. So until the market finds price acceptance underneath 672.65, this is such a back pocket idea that it's not worth spending any more than the time we've already spent on it. And therefore, I'll move back to the hourly chart and we'll go ahead and take a look at the intraday anchored VWAPs. Okay, so what do we see here? The bear engulfer anchored VWAP is supportive still near that daily 20 SMA, reinforcing this key structure. You could see that the high side anchored VWAPs from the all-time high, this gap up, as well as this pivot low, are certainly confluence near this 680.50. So it would be more compelling if the market could do this and clear that anchored VWAP structure, right? The main name of the game, if we're looking for the upside reversal, you basically want to see this, then this, and then this. You know, maybe this becomes, I know I've overused the word this in this sentence, maybe that becomes inverted head and shoulders, right? You primarily want to get back into this. You do not want to see overhead supply continue to weigh on price and push things back into this repeatedly. You pretty much want a sharp V-shaped recovery off of the daily 20. The more time we noodle around and just kind of chop through it, the harder it will be ultimately, without a catalyst, to find a daily higher low, right? It's telling us that the market is accepting prices lower. The final thing I'll say here before we take a look at some supporting evidence categories like the market internals is that this should not be a, oh my goodness, my jaw hits the desk, I can't believe the market's pulled back move. The market cannot go in a straight line, gap and go, gap and go, gap and go, and expect to not backfill some of these prices to determine basically if the auction is going to find fair value. So this is nothing out of the ordinary. Anybody who's making an overly bearish case about the market currently just doesn't really understand market structure, right? So we've pulled back about 2.25% from the high. This is hardly a 3% pullback. You get anywhere between about 7 to 10, 3% pullbacks, mild, pullbacks in the market a year. This is well within the realm of normal outcomes for the market. It's not some groundbreaking, oh my God, the bubble is going to pop. It's right here. It's right now, right? We'll start having that conversation when the weekly trend flips to down. We're just not there yet. So let's take it one step at a time here. Let's jump on over to the NASDAQ because before we get to the internals, I do want to talk about this back to back a little bit, where the NASDAQ still has some room to fall into its gap close area. So if the NASDAQ is required to pull back and test the gap close at 611.40, it may mean that overshoot in the S&P 500 towards this 669.65 zone. And the reason I'm giving the market that benefit of the doubt there is because of this previous congestion in that area. If we overshoot and quickly come back out of it, that would certainly qualify as long as the QQQ, the NASDAQ side of the market, was clean up against its gap fill reversal, right? Something like this, over the daily 20 again. Okay, so I did want to put that back to back in tandem. We'll get through a deeper NASDAQ analysis in a moment, but let's take a look at the market internals. If you're not familiar with this dashboard, check the video tutorial in the top right hand corner. I would say the internals really indicate more of a rotation. So the theme and the basic question that you typically want to ask is, do we have indications here of new money initiative sellers on the pullback forcing prices through the ideal higher low zone? And the answer to me is not really. As the pullback developed, right, mild volume outflows on Monday, nothing substantial. Tuesday is undoubtedly going to be stronger volume outflows because of the size of the gap and the fact that price action could not get overlapping to up on the Monday session. Today almost unwinds that a little bit now that we had a bit more of a neutral open, literally, trending cleanly higher off of and reflecting what we had in price action itself. I'd say a similar comment here on the advanced decline line. We did not spend time pegged underneath negative 2,000, and instead today we also moved in the upward direction, counterbalancing the move from Tuesday. And again, rotation, some aspect of movement into safety names. You could see here through the watch list, some names are bright green, some names are bright red. Some sectors are green, some sectors are red. So we are getting a bit of a rotational aspect, and the internals help indicate that. You could see here that the index, not the index score, but the cumulative build on the tick is once again back-to-back opposing reads. It's not like sellers have dominated this market for 3-4 days in a row and everything's falling out of bed. It's been a pullback. We've seen some sell-side pressure in the sectors where it matters most, semiconductors, right? But now we're starting to see a rebound, and there's not an overwhelming notion of at the exchange level, everything is just continuing to sell it all, it's garbage, get rid of it all, and market's going to crash. We're not really seeing that. I would have expected much more substantial negative 1,000 prints on the tick if the market was going to sell off more aggressively on the morning low, opening right at that Tuesday low, testing underneath Tuesday's low at one point in the lower wick. It just didn't happen. So those are your internals. Let's take a peek over at the market profile. You'll notice a couple of things right out of the gates here. First of all, if you don't know about market profile, check the video tutorial top right-hand corner. Glaring poor high at the high of day. So that lacks material excess. I would imagine it needs repair at some point. And the other thing is that value technically shifted overlapping to up on today's session. Point of control is right at, just a hair above the Tuesday high. So when I think about where the close was, it was actually disjointed from value in the point of control. And it wouldn't seem unreasonable, right, that the market tries to establish value over Tuesday's range, over Tuesday's value. And if that's the case, continuing to see value here sets up that move for the Brigade Bolt over 680s on the S&P 500 that we were just talking about in the Spider's Cash. Now, we're opening, and as of the comments into the close, based on Jensen's NVIDIA comment, we're opening middled, or the post-market is middled in today's range. And the threat will just be, if we take out these lows, you have to look at the overnight low from today's overnight session, or what would you say, yesterday's overnight session, today's pre-market session, okay? That would be the same thing as the gap fill reversal we just talked about over here on the Spider's Cash ETF, no problem, right? We just saw on the hourly chart, if I throw the extended hours back on real quickly, we just saw that this is the exact spot we just talked about, right in here. Is that not still the opportunity for the higher low? Yes, it is, okay? So those are the takes. There's nothing overwhelmingly bearish about this. I think that the pullback has been fairly controlled so far. We have a responsive market. We don't really have an initiative market yet. When and if we can spot that initiative buyers are stepping up, that would be a bit more of a compelling argument to start really leaning into the long narrative and seeking equal highs, all-time highs, if not continuation, into the end of the year. Let's take a peek over at the NASDAQ. We'll go a little bit faster over here now that we understand the general premise of what's happening in the market. It's the same thing. You're pulling back from the highest high. The hourly trend is down. There's a firm higher low opportunity here over previous resistance, which can act as newfound support. The gap fill reversal level is 611.40. Daily 20 SMA is currently a little bit higher than that at the beginning of the gap at 615. Lower edge of the weekly expected move 616.07 so far. This is certainly still looking like a higher low. I would argue, though, just like the S&P 500, responsive off of the highs from the Tuesday and Wednesday session. Another very slight nuance here on the NASDAQ is that we have not closed the gap all the way to the upside. In the S&P, buyers did their job. They closed the gap all the way. In the NASDAQ, buyers did not do their job. Monday's low is here, and instead we reject the bottom end of the overhead supply. It doesn't really change things all that much, but it does mean that there may be a stronger sell-side presence here, not allowing buyers to rotate through what is, again, thin structure. There's nothing there. So in my view, neutral, possibly looking for that deeper pullback for a regular trading hours test of the daily 20 SMA doesn't seem all that far-fetched as long as the hourly trend remains down on the NASDAQ and price acceptance is happening here underneath 627.25 previous range lows. Okay, so this and then some kind of gap fill reversal. Understand that that spells overshoot in the S&P 500. As long as the NASDAQ is respectful of its gap close at 611.40, I will be okay with the overshoot in the S&P, and I'll continue to maintain that bullish stance. Let's come in here with the fibs from the highs to the lows. We really don't have much other than the 50% fib smacking the bottom end of the range here. Fib 61.8 is over the gap close. And if we come in from the major low here up to the high, we are staying over the fib 50%. 61.8 is confluence in this zone. And I do believe if we bring in from the engulfer low up to this high, 38.2, right on the money, that high now acting as support. So far, I mean, it's a little far-fetched because it's not really a clean flagpole, but this could certainly be construed as bull flag consolidation over previous highs, over the fib 38.2. Not much of a bearish argument to build here. At best, I would say the bears can go neutral and start thinking about, okay, maybe there's some pressure to close this gap, but when and if that goes gap fill reversal, there's not enough of a strong indication yet that's indicating a full market collapse and, oh my God, we're going to zero. I mean, you just saw it from Palantir earnings and AMD earnings. They beat really strong on the numbers, and they also offered decent forward guidance. The market didn't love it. I guess it was looking for a little bit more, but it's not like these companies are running out of steam and, wow, where'd the revenue go? It just suddenly vanished. That didn't happen. It's a concern that good news is yielding negative results, and we'll talk about that when we get to those core listed companies. But for now, it's not bubble territory where, wow, there's just no revenue to speak of, and this is all just a fugazi, right? So that is your QQQ analysis. Let's jump on into our NASDAQ internals, continue the conversation here. A little bit stronger volume outflows on the sell side from Tuesday, over-correlated on Tuesday, snapback, snapback, snapback. once again, seems more rotational to me rather than outright new money sellers being initiative to the downside. Just can't make that call. And, bare minimum, no pun intended, bare minimum, you have to be here before I'm changing my tone on the higher time frames to being a mega bear. Just doesn't make sense. Does not make sense whatsoever. Let's go on over to the market profile for the NASDAQ side of things. And what do we see? Rinse and repeat, right? I'll save you the hot air. Poor highs and this value area slightly overlapping to up. Point of control is more unchanged, though, on the NASDAQ. One thing I will say, we didn't talk too much about it on the ES, but on the NQ, it's even more obvious, right? It's even more obvious that you undercut the Tuesday low. Sellers cannot find price acceptance down here. Look at how little volume was committed versus where all the point of control volume and value area volume was. Market's much more content up here. So auction-wise, sellers unwilling to sell at the bottom end. And remember, market's bottom when the final seller sells. Let's jump back on over to the platform here. Let's finish up the broad market with a quick look at the Rusty, and then we'll keep this thing moving along through our sectors. No comment, middled in the range. So in terms of new outcomes, just a simple range low support, bringing us to the midpoint. Next call will just be, do we make it to the top? In which case, expect responsive trade, rejections off the top end. If it breaks out, then fine, we'll go with. That, of course, will be bullish pressure for the S&P 500. If this rolls for a lower high and we find ourselves at the equal low again, be open-minded to this, right? Why would we be open-minded to that? Well, let's think about the fundamental narrative, which is always a little bit more intertwined with our IWM. This morning, we got the ADP non-farm, right? ADP non-farm came in stronger than the expectations, and therefore, that means that Jerome Powell's hawkish stance from last Wednesday's meeting probably can be validated. We also saw a similar concept in terms of the implications from the fundamental narrative out of the ISM Services PMI, which we'll talk more about on the calendar in just a moment. So in terms of smalls, I'd be neutral through here. Jerome Powell remaining hawkish makes a little bit more sense. If we rotate to the top, midpoint rejection. If we get back down here, be open-minded to this short, remembering that interest rates probably don't have to be cut as aggressively as the market was once anticipating into the end of the year. Double rejections on the attempt to break out of the balance range here is still overhead supply that's trapped. I don't think we're out of the woods, but I wouldn't be a mega bear. No need to be a mega bear in smalls. It seems more neutral and balanced than anything else. Not really a shocker there. Let's take a look at the hourly chart. Not much new to learn. Sorry for the zoom there. Just a simple rotation off the low here to the midpoint. No need for it's so middled that it's not even worth fibs and anchored VWAPs. Midpoint of the range, let it be. Neutral data point, moot point, if you will, for the S&P 500. Let's quickly take a look at the Russell side of the internals. Okay volume inflows, okay advanced decline line, back-to-back opposing reads on the cumulative build. Again, this screams rotational to me, which, remember, rotational is going to prevent an outright market collapse. You need everything selling all at once if the market's going to come in hot and heavy and see something like down 10% over the span of a week and a half or something like that. Everything needs to sell off, and you're just not getting that, right? That could be around the corner, but the indications just aren't there as of right now. Let's keep moving, and let's take a look at the S&P sectors. Weekly performance to start. Let's zoom in here so we just have the S&P as a reference, a little bit easier to see. There we are. So leading the pack this week is actually real estate, which doesn't make too much sense to me considering rates are up, but we'll let that be. Healthcare is certainly up there as well. That's bullish in terms of the rotation thesis. Financials also bullish here, up 52 basis points, also bullish on the rotation front. I think this aligns with what we just talked about on small caps as well as market internals. Bottom end of the barrel is the XLK SMH via the gap downs from Tuesday. However, intraday today, they certainly caught a bid. If we were to refilter this by today's performance, you can see that the leaders are semiconductors, discretionary, healthcare, tech's even up here still. So it's not all that bad. I would not say that we have defensive posture or risk off or anything of the sorts. It looks normal in terms of rotation on the pullback. Let's move through some of these charts and just take a look briefly at what the structure suggests. Is there any reason to be a mega bear if the SMH is looking like this? Absolutely not. This looks great. As long as we're over the 20 SMA gap fill reversal, we have 346. No problemo. I do think that we want to maintain a little bit more of a responsive stance off of this 361.25 spot, the multi-day overhead range. If we reject below, yeah, I think the pressure could be on for the full gap close, but it's just not mega bear. It's like neutral consolidation, higher low pullback in an uptrend, not continuation, right? Let's take a look at the XLY. I don't want to say it looks primed for a breakout, but you can see I have my alert here. I do like the fact that we have this higher low set. This is abandoned baby. If we can Brigade bolt through those highs, are we ready? Maybe. I think Tesla's the next one to watch, of course, with the pay package deal being top of mind for a lot of investors, a lot of people talking about it. If Tesla goes, XLY will go. So watching that very closely at 242.50. Next up, healthcare. Nice little response here on the higher low on the daily chart after breaking out of this range and pulling back, right? This was looking a little sketchy on the pullback here back into range. Like, okay, why didn't we get continuation for a more meaningful high? But as of right now, this little bid has been helpful. I think that this looks fine. This once again speaks to rotation. Let's keep going. Industrials, midpoint of its balance range. No comment, but certainly not bearish, right? Moving along to communications, a little bit more bearish here. Got to give some credit to the bears where credit is due. Highs, lower highs. Is this going to be a double top under the neckline? We know the daily trend is already down. It flipped to down here on this lower high. Obviously, we have lower lows as well. So now the weekly double top becomes the concern if this starts to break. I'd be watching this very closely. I should stop saying the word obviously. It's a goal of mine for 2026. It is clear that metaverse is one of the big issues with the XLC, which is kind of interesting though, because if we just go to the Analyze tab, you can see this. Because Google's listed twice, and Google has much more relative strength. So kind of interesting there, but the XLC does appear concerning near this low on the neckline of a double top. That's a sore spot for the market here. If we take a look at the XLK, it's a rinse and repeat of the QQQ as well as the SMH. No problems here. As goes tech, as goes the market. Or so goes tech, as goes the market, however you want to say it. Energy, no comment, midpoint of the range. XLF, it performed well today in terms of thinking about rotation. Same thing with weekly performance, technically green here. It's just still underneath this overhead supply, which is a small concern. The reason I say small concern is because the big banks actually look fine here. We could quickly take a tour through JPM. You could see it looks okay. You could take a look at MS. You could look at WFC. You could look at Citibank. You could look at, what have we missed here? I don't know. God, what's another one? GS. We'll end on Goldman Sachs. It looks fine, right? So these banks are doing all right. It's the payment processors like MasterCard off the highs more considerably, and like Visa off the highs considerably. Now, this is interesting because AXP is actually sitting on the high. So I think that speaks a little bit to the demographic that's continuing to spend. But nonetheless, when we go back over to the XLF as a sector, the large banks doing okay is a better indication, in my view, to Wall Street and just general deal-making activity. Mergers and acquisitions, just things happening on Wall Street. That's bullish. You don't see that in the peak of a recession. No company is like, hey, it's a recession and let's just go blow a bunch of money on a speculative deal and maybe it works out, maybe it doesn't. That's not how that works. So as the XLF looks a little bit more reflective of MasterCard and Visa, I think you should probably focus on those banks a little bit more so. Let's take a peek at Staples. This continues to be a sore spot as well. So we've seen two sore spots. It's communications and Staples. Utilities look okay. Higher low pullback over the previous breakout high. No issue there. Lightweight sector. XLB, sore spot, but it is the lightest weight sector. It's supposed to be an L for lightest weight, not D for defensive. Yes, new lows are a headwind for the market, but if this were to bounce, it will add to the rotation theme. We're not there yet, and I would pay attention to interest rates for this. You could do the same thing with the XHB as a proxy for home builders. There you have it, right? So it looks a little bit softer here, and we know that's because TNX, CGI, rates have been on the move ever since Powell cut rates, ironically, right? That's always how it goes because it's an expectation game on Wednesday of last week. So that is your TNX HYG, sorry, not HYG, but XHB, too many H's, home builders, and materials. Let's go TLT. I'm interested in TLT short puts as an if this breakdown continues. I don't think that it's in play right now. Implied volatility is not high enough to want to get short puts on TLT, but if this starts to really come in aggressive, that would be a bit of a concern, noting that, we're doing all right economy-wise, seemingly labor-wise. We'll see. More data needs to come out on that. But if the Fed's going to take a softer stance, we know that we're not going back to 5% Fed funds rate. I don't think that the TLT should be trading at 86, give or take. So anyways, TLT short puts at some point when and if IV is correct. We're not there yet. Keep an open mind to it. Real estate, last but not least, doing okay on the week, but not for any miraculous reason. It's still at the bottom end of the balance range. Remember, this has a lot to do with wealth effect. If real estate really starts breaking down, if rates really start to ramp higher, 5% on the 10-year, you might see people start to dial back spend as perceived wealth wrapped up in net worth from home value goes down a little bit, right? You'll start seeing headlines like, home values are pulling back, and that gives people the heebie-jeebies a little bit. Let's take a peek over at the ratio grids and see what's going on from this perspective. Risk on, risk off. You can see this is still the glue holding things together. I like the improvement out of the XLY. Remember, Tesla will be a watch for whether or not this continues to perform well. Still a problem child, still a problem child. This is not really risk off yet. This is not risk off. This is not risk off. So I would think that we're doing all right in terms of posture. It is not risk off, but it is not all rainbows and butterflies on risk on. These lean primarily XLK related, SMH related, as you can see here. So the most apples to apples comparison is this, and that still does lean risk on. So I'd be bullish from that perspective. The ARK-K Innovation Fund is technically underperforming our S&P recently, not as great. Small caps over here looking all right, plenty of room for the higher low. It's, again, a bullish data point, which is going to prevent me from getting overly bearish if we're still over key location on the S&P 500, which, of course, we've talked about we are. The dollar is getting a little bit tighter here, pressuring markets lower. That seems okay for now, considering what's happening with rates. I'm not overly concerned about this yet. I think the more pertinent time to pay attention is when the labor data comes out, is released. Let's go on over to inverted ZT. Small uptick here. I would just expect odds of a rate cut to have gone down for the December meeting. Let's go over to the Fed Watch. And yes, they have gone down indeed. So 61.5% odds now of that 25 basis point rate cut. That's down from about 79% this morning and 85% prior to the Fed. So the market is taking the ADP number. Remember, let's just go take a look at this stuff. ADP number came out this morning. Look at the beat here, 42,000 versus 32,000 expected. Previous was revised up from negative 32,000. I think I could see it if I hover my cursor. I know it's really small on your screen, but 32,000 was prior, revised up to 29,000, negative 29,000 still, so a contraction, but it was a revision in the right direction. So this will allow Powell to maintain that more hawkish stance. And if we look at the ISM Services PMI breakout, let's go over here for that one. Let's close some of this stuff up as a distraction. Services PMI, employment beats the expectation and prior, right? Here's your expectation. Here's your prior. Nice beat. If you look at new orders, they're technically up and beating expectations. If you look at services prices, they are up, beating expectations and over prior. What does this spell? Possibly higher inflation. Fine on the employment front. JPOW gets the card to pull that hawkish rug out and say, hey, December's conclusion is not a foregone decision. Far from it, right? As he typically says. He got a little bit of flack from the president today. I think he was literally called, quote, a nincompoop in the conversation. So Powell continuing to just get peppered with some pressure, to say the least. But the data itself says, hey, maintain your stance and do not succumb to the pressures of Super Dove Mirren. Let's take a peek at the remainder of the calendar for this week. There's a lot of Fed speak tomorrow. I'm not concerned about it. What I am concerned about is when this data comes out. That will be a tidal wave of information for the market. This will come out. It's a private number, of course, thanks to the good folks at the University of Michigan. Consumer sentiment and inflation expectations, Friday morning at 10 a.m. Don't forget it. Let's take a look at the earnings calendar. As we know, AMD, Palantir, and Robinhood are the major offenders, dare I say, this week. Palantir, solid results, market gap down. AMD, solid results, decent guidance, same thing as Palantir, market gap down. AMD did stage a strong recovery effort intraday, whereas Palantir has been a little bit more sideways. Robinhood, last I looked, was unchanged after hours, but that was before the conference call. We'll take a look at that together in just a moment. I'd say that into the end of the week, some honorable mentions, nothing overly market moving, but honorable mentions. D-Wave for Quantum, IONQ as well after hours today, AppLovin, these two. For semiconductors, of course, Figma, honorable mention, honorable mention, honorable mention Datadog. I'll go honorable mention Trade Desk, Open Door, MP, IREN, probably SMR and Archer, and then Constellation Energy as well Friday morning before the open. That's your earnings calendar for the remainder of this week. Nothing overly market moving. I think that Robinhood is our last major stock to watch, and then we'll drift off and wait patiently for NVIDIA, which is always late in the cycle. Let's get back on over to the platform here and take a peek through our remaining supporting evidence categories. These are all moving higher in tandem. When they get disjointed, when this isn't a downtrend and this isn't an uptrend, that's a concern. We don't have that. This is just responding to the more hawkish data that's been coming in, allowing Powell to keep rates higher. Credit spreads getting a little bit tighter here, a little bit tighter here. I think that this is well within the realm of reason with an increase in volatility. What I'm watching for primarily is the lower one. Does this rotate back underneath that daily 50 like what we had over here? If that's the case, then great. Not overly concerned about this one. I always give this one the benefit of the doubt. IEF LQD, a little bit more leeway. Junk and shorter end is a bit more telling in the near term. Let's jump on over to junk in isolation, which continues to be a red flag. So if you're like, Matt, I just can't get behind this long off the pullback. That's fine. You would want to be someone who leans into the idea that the HYG is warning us that it is not a pullback to buy. Now, I'm going to caveat the statement I just said. It's not a pullback to buy. This is one data point in the full analysis that we've conducted so far. Now, it happens to be a very important data point, and the HYG has been very influential in picking when you should be aggressive or dial back on the market. So you can clearly see the slope of this line. Actually, I think it gives us a percent. Yeah. The angle of this line, hover my cursor here, is 33.29, right? Negative slope degrees. This one is negative 12.77. So you're clearly getting more bearish pressure here in junk bonds. And I would also just point out that if you look at this to this, I mean, that one seems fairly obvious. That's the correct use of the term obvious instead of obviously, right? Just clearly a lower low. So in my view, the HYG is the singular data point so far that is the more compelling data point to say, nah, I'm just going to hang tight on this pullback until the HYG maybe breaks and makes an equal high here. If you notice HYG trading 80/80s and the S&P is trying to stage the recovery over these prior structure highs, that would be the time to say, aha, now it's time to get long. Junk bonds are agreeing. Okay, so really important data point there. Let's move along to total breadth. I'd say it's stabilized. We know breadth has been an issue. We had that big Hindenburg Omen Armageddon signal. Everybody already forgot about it, right? It's classic. It's just a talking headline. Just pay attention to the chart structure. For now, breadth continues to be an issue. We're not out of the woods, but it has stabilized. It hasn't gotten much worse here, here, and here. And we can see this reflected in the RSP as well, noting that you can clearly see that there, midpoint of the range. Versus anything more meaningful. Like if this was breaking down more aggressively, yeah, oh my God, I'm not buying that gap close. Are you kidding me? RSP's falling off of a cliff. But if we're neutral here, yeah, maybe you will entertain the gap close if the hourly structure can shift and drift in the upward direction into an hourly uptrend again. Let's go on over to the volatility side of the market. Volatility backing off today, and even the VVIX, I'll just drop it in here without switching the screens via the tab. I mean, it backed off under 103. In a more aggressive bear market, this should be ramping higher as the market goes sideways. S&P goes sideways. It's just not happening. If you look at the vol futures, the contango is still very much so in play here. This is in play on the 9 versus 30 day. And the 1 day, although still elevated, is not tracking, 24s, 25s. I'd say be more confident in the market bottoming out when and if we get an open on the 1 day VIX down here around 745. That would sort of be not the end all be all for a bottom, but that's when things just return back to normal, right? This is normalcy in the 1 day VIX. So 745, big watch on that. Let's take a look at the skew. I haven't looked at this in a while. It's been less important these days. It's been kind of range bound. So nothing to parse out from that. I would just say if it gets overly elevated, you have people starting to price in black swan. We just don't have that. It's not making new highs. It's kind of towards the upper portion of this range maybe, but not really anything impressive. So with that, let's jump into the core list of companies. Let's see what's going on over here. Then I've got 4 additional ideas to share with you. NVIDIA, Jensen, my goodness, saying that AI in China is going to dominate the US. Yikes. Big end of day reversal. Big bummer for me, honestly. I was short NVIDIA in here, closing out well in advance of this. So just kind of a bummer. But double top, I think the main thing to take away is that the double top neckline did offer the bearish Brigade bolt. And for now, the bears have control. If there's a walk back on this, maybe there's some kind of rotation to here, but the bears are in control, structuring this chart in the downward direction. I would take a short-term bearish approach looking for this, and then a longer-term bullish approach when and if we approach this gap close area in here around 189.50. Going back to the daily, we can see that that is where the market really staged the rally from on NVIDIA. Earnings are further out on this one, so there is still some time. If we get here, that is still a place where I'd be looking for pullback longs, daily 20 SMA mixed in there at 189.50. Moving along to Microsoft. This is a threat still on the weekly for a huge double top if we were to take out the neckline. We're not there yet, but just noting that the earnings, has not done anything helpful for upside here. We're consolidating in this range rather than hammering and getting over the high. To me, is a reasonable threat. You have all these equal lows. It's probably looking for downside here under 506.50 on a big flush. If you go to a weekly chart, you'll see that as major weekly lows, right? And that's 1, 2, 3 major weekly lows all stacked in there at 506.50. It wouldn't be unreasonable to break that and seek some downside here on Softy. From the hourly perspective, bear flag consolidation sub 510.25. It's not my favorite chart to short, just because it hasn't really been moving cleanly. It's been much more responsive. So looking for an initiative short, The broad market would really have to be collapsing through the key zone. I'm talking S&P and NASDAQ for me to want to initiate new money continuation short on Microsoft. We're not getting really a thin structure retracement like NVIDIA was. Let's go on over to Apple. Let's go back to a daily time scale. The place I'm looking for response first is over these prior highs. Can that act as newfound support? So far, just balanced. Be open-minded to this. No earnings to contend with. The deeper pullback would just be in here over these prior highs. That's 258.65. So I don't think Apple is really doing anything compelling on the daily bars, right? On the hourly bars, nothing here also. It's kind of no man's land, choppy zone. If we get this, it's a helping hand for this trade. Even that, once again, think about this concept of responsive versus initiative. The market has been much more responsive. So trying to pull off the bullish breakout long over 270.250, I'm not like jumping for joy about that particular trade, but it would be there. Let's go to Amazon. This looks like a great opportunity. Can we find the move though? You know, everybody can see this. Everybody's waiting for it. Can we get Amazon back into those prior all-time highs? 242.50. It's this entire zone I would treat as supportive. If we just slice through it, that's a different story, talking about the gap close and maybe Bezos is at it again, selling some more shares. But for now, I would really watch this zone for a potential higher low. Today's daily hammer gives us, you could hypothetically say it went look below and fail on Tuesday's low, and now we're looking for upside. This is a false upper wick on Amazon, by the way. Thinkorswim's been absolutely terrible. Send user feedback, please. If you're on Thinkorswim, reach out to them. Say, hey, get your data figured out. This doesn't happen on other platforms. What's going on? That upper wick is false, so this here would kind of be the next idea. You're just trading in a range. I would pass on Amazon personally, so let's not spend too much time on it. Google, you could see the thin structure retracements available, but it's had great relative strength recently, even on the daily chart, and we've talked about this, you know, ever since this gap and go on the lawsuit resolution. Considering this, I think it's, if we are going to look for an initiative trade, let me frame the market this way. Google is the one. Google's had the cleanest trend. It's had the nicest moves. I think Google is the place to be if there's going to be a change in tone from the market. If we are going to start initiating new money buyers, stepping up, buying this thing, sending it higher, we do have that unrepaired overnight high to contend with as a target. Here it is on the hourly. Consolidation here is in service to this potential move over to 285.50 into the all-time high 291.65, then walking it up from there. Let's go to the metaverse and see what's going on with Zuckerberg and his, what is it, Reality Labs that all the investors are upset about. It's just losing money. It's a cash burn. In terms of Meta, no relative strength, well underneath and off of its local highs, under the daily 200. You know what they say, nothing good happens under the daily 200. In terms of downside reference points, it's really just this gap and then another gap from earnings in the April tariff lows and resolving that. Let's just set these to yellow really quickly. Sorry to waste your time and do this together. I think it's a worthwhile exercise though. Then we'll go 85 in yellow on this. That's looking fine. Good for now. The point of the exercise is to just say this downside drift is like there's some room for it. If it's going to go, there's some room to go underneath that daily 200. Let's go to a weekly chart just to make heads and tails of this. Yeah, nothing I would be overly happy about longing here until we get all the way down, like this area on the weekly chart at least. You know, this is thin structure on the rotation higher out of it. So hard pressed to be a bull from Meta. If we take a look over at the daily time scale, as soon as we lost the daily 200 on earnings, that was your warning sign across, you know, shot across the bow. If this can recover and do this, I'd be open-minded. It would pique my interest. And then this gets interesting for the gap close above. But for now, I don't want to say dead and gone. And the short-term trade is lower high Brigade bolt underneath 647, hence the alert. So shorts here for rotation to the gap and then maybe through the gap, right? This kind of idea like that, but not in love with the chart. Let's go to Tesla. Tesla, big vote on the Elon Musk $1 trillion pay package. Some interesting headlines today fueling the market higher off this low. I'd be curious to see what tomorrow brings if there's any overnight news or decision on the vote. If we can get a gap up on high volume, the all-time high breakout on positive news as a catalyst, this is going to have one of those days where it's up 7%, right? Up 9% on the session. So I'd be very open-minded to Tesla trying to break out of this if the catalyst is correct and if the volume is substantial on tomorrow morning's pre-market session, okay? If we're just in this range, no result on the pay package, avoid the chop. It's a new junk drawer. Let's go to JP Morgan. We talked about it a little bit with the XLF. Watch these highs over 312.65, all-time high target. We take a look at Palantir. I like the daily hammer rejecting sell-side pressure inside the junk drawer. maybe a long over today's high for Brigade Bolt to the upside, but once again, market's been more responsive, not so initiative. Trying to take this trade here, maybe the argument is that we're responding to the daily 20 SMA, and we're not, obviously it's not an all-time high breakout. So that could be one stance to take on Palantir 190 watch. I'd keep an open mind to that. If we're just chopping through here, a little bit less compelled about new trades on Palantir, needs better structure. I like Broadcom quite a bit as of the pullback on the close from the hourly perspective, but the daily doesn't look great. The daily has failed the all-time high breakout here. The pullback has not supported over this level. The only thing going for it is on the hourly chart. If this wants to turn into inverted head and shoulders, you have to hold tomorrow morning over 358.25, heck, even open on a move higher, pullback support, and then you're probably trying to fight through some of these local highs into that 372.25. That's my take on Broadcom. I like what it's trying to do. It's just not clean yet. Not clean, and unfortunately, that makes it hard to participate. Let's go on over to AMD earnings candidate, right? Nice hold of the daily 20 and the top end of this ascending triangle breakout. So to me, consolidation back here stages this for the potential of an initiative break when and if the market pulls itself out of this funk. That's what I'd be watching for here on AMD over something like 65. As of right now, I'll take it down to the hourly chart. This is one of the only names that was not responsive for a lower high underneath this level, right? On the gap down, hypothetically, and it was like, I don't know, maybe for 15 minutes intraday, there's a little bit of a flag there, but then it broke into the afternoon, right? So this should have been, quote, should have, nothing ever has to be, but if you're a stronger seller, you want to see the lower high underneath this overhead supply. It didn't happen, so now going forward, once again, this is in service to the Brigade Bolt over the high, as long as we can hold up over 252.75. Next up, Robinhood. Earnings after hours looks like we're tracking 139s in the after hours session, which brings us towards the lows of this morning. So not detrimental, but underneath the conjoined twins neckline, if you don't know what that pattern is, it's the double top that shares a neckline with the double bottom. There you go. So not much to really say about it. It's just building out a sloppy, unfortunately, new range, and the neckline's not really all that respectful at 141. I'm looking for some new information on Palantir. Maybe it's tomorrow. If we get this Brigade Bolt under the low, possibly we're in store for a deeper pullback. Now we start talking about weekly double top, right? So I'd just be watching today's low very closely, considering that in the after hours, if I just throw on the extended, you're pretty much unchanged in here. So watch today's low like a hawk on Robinhood if there's going to be a short. If we just noodle around in here, it's probably more difficult long to pull off unless the broad market's just screaming to the upside. All right, so that's your core list of companies. Let's jump on into these ideas. Snowflake is up first on the docket. This is a possible short. Bearish 3-bar play with the inverted hammer inside the inverted hammer from 11.4. Underneath 263 hits the trigger on the alert here, and we have a thin structure retracement back into the top end of the breakout zone at 253. Here it is on the hourly. Let's turn off those extended. Oops, turn them off, not just unhighlight. And there you have it. Lower high, head and shoulders, whatever you want to call it is fine. H pattern, cool. Under 263, nothing here. Not much there. Looking for that 253 target. 10 points. 10 points of range to trade for on Snowflake. Keep an open mind that you probably have to play the spread and be dancing around over here. Let's go over to volume, please. Yeah, you're going to have to play the spread and dance around if you're going to use options. Otherwise, it is easy to borrow if you want to just short shares. That's Snowflake. Next up is going to be on, we already looked at these, so I'll just rattle them all off once again. Morgan Stanley is really the one that caught my attention of the banks, just because of the daily structure here. Inside candle, still holding at the highs. It has not swept the high, unlike Wells Fargo. If I go to Wells Fargo, notice how we whipped through these highs a couple of times. That, to me, gives a bit of a false sense of hope, like it was a false start. So buyers who are trapped, they're probably feeling like, ooh, that's not really it. So back over on Morgan Stanley, you probably have a better opportunity to have an initiative buy if the broad market conditions are right and a cleaner hourly level that has not been tested or broken yet. So this would be the idea over 167 if financials are going to catch a rotation. Okay, MS Morgan Stanley, top of the banks as of right now. IONQ has earnings, but it does have a beautiful level in play. I did want to bring this one up. So earnings look like they're at 57s, 57.50s, which is a small gap up forecast as of right now. If this fades though, right? If this fades, check this thing out, right? Kind of a quasi head and shoulders, whatever. But this equal low breakdown is a thin structure retracement from that mega breakout, right? into the top end of the balance range. I'd be very interested in that if there's a big failure tomorrow to maintain, 57.50. So if we open on a gap up bearish engulfer, close in here, it could be an end of week Friday trade. I'd watch this very closely at 52.75. Very, very closely. That's IONQ, short for quantum. And then let's finish up with TSM, semiconductors. How do we make out over here? We have a 294 post-market. Just want to be cognizant of that with ARM and Qualcomm reporting. Look at this bearish candle. I would say if this fails the 293.50, you could trade into this low here. So that would be something that looks like Brigade bolt underneath. Target this low, 286. All right. So what is that? 9 points to the downside to trade for on this TSM. If it supports the bottom end, this is another takeaway. Because we've talked so much about in today's episode of the market being responsive, another watch here is if this wicks the low and comes back above for a higher low, you should, noting the tone of the market these days, trade the look below and fail as a rotation back up towards the highs, right? Sellers not initiating new money sell side pressure. Buyers just keep it in range. Old money business continues to transact. Everybody's like, ooh, kind of neutral. What's going to happen next, right? So shorts get, as the kids would say, cooked, and then you rotate to the midpoint of the range. Not an, oh my God, breakout new all-time highs trade, but just a long off of that 293.50 recapture on a look below and fail. Okay, that's what I have for you in today's episode and installation of the midweek market update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we'll be live, as we are every morning, at 8 o'clock Eastern time for another episode of the pre-market prep. We will see how the information comes out tomorrow morning, what happens overnight, how does Robinhood develop, and we'll build a game plan more in line with any pre-market updates. That way you are prepared for the session. If you enjoyed, once again, all that stuff we're supposed to say, links in the description, subscribe button, bell button, notifications, thumbs up, whatever. Have yourself a green and fantastic rest of the trading week. And as always, I will see you in the next one.